Scene script. Have you ever wondered how the wealthy keep getting wealthier? The secret often lies in smart investment. Now, let's break it down. What is an investment? It's simply the act of allocating resources, usually money, with the expectation of generating an income or profit. In other words, you're putting your money to work to start creating more money for you. The importance of investing cannot be overstated. It's a crucial step towards financial independence and building wealth. And here's the kicker: growing wealth is not a privilege reserved for the wealthy. No, it's within reach for everyone. Investing can be your ticket to a more secure and prosperous future. It's about making your money work for you, opening up opportunities, and ultimately achieving your financial goals. Investments can help you grow your wealth, no matter how small or big your initial capital is. Investments come in various forms, each with its own set of advantages and risks. Let's delve into some of the most common ones. First up, we have stocks. When you buy stocks, you're essentially buying a piece of a company. As the company's fortunes rise, so too does the value of your stock. On the flip side, if the company doesn't perform well, the value of your stock could decline. Next, we have bonds. Bonds are a bit like an IOU. When you buy a bond, you're lending money to an entity. It could be a corporation or the government. In return, they promise to pay you back with interest over a certain period. Unlike stocks, the returns on bonds are usually fixed and predictable, but they're often lower. Then there are mutual funds. These are investment vehicles that pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other investments. They're managed by professional fund managers, and they can be a great way to spread risk and gain exposure to a wide range of investments. Real estate is another popular type of investment. This could involve buying property to rent out or sell at a profit. The returns can be lucrative, but keep in mind that real estate markets can be volatile, and property requires ongoing maintenance. Finally, commodities. These are physical assets like gold, oil, or agricultural products. Investing in commodities can be a good way to hedge against inflation, but the prices can be volatile and influenced by a range of factors, from geopolitical events to weather patterns. Each type of investment carries its own risk and potential for return. Stocks can offer high returns but come with high risk. Bonds are lower risk but offer lower returns. Mutual funds offer diversification, while real estate can provide income through rent and potential capital gains. Commodities can be a good hedge against inflation, but their prices can be unpredictable. Understanding the different types of investments allows you to choose the right investment for your financial goals and risk tolerance. One of the secrets of growing wealth through investments is the power of compound interest. Imagine a snowball rolling down a hill, gathering more and more snow as it descends. That's compound interest for you. It's the interest you earn not just on your initial investment, but also on the interest that your investment accumulates. Let's break it down. If you invest $100 and earn 10% interest annually, that's $10 in the first year. Now, in the second year, you're not just earning interest on your initial $100, but also on the $10 of interest you earned in the first year. So you're earning interest on $110. As time goes on, this interest piles up and your investment snowball grows larger and larger. It's a slow and steady process, but over the long term, the results can be dramatic. Compound interest can significantly increase your investment returns over time, making it a powerful tool for wealth creation. Investing is not without risks, but with higher risks often come higher returns. This statement may seem paradoxical, but it's a fundamental principle in the world of investments. So let's delve a little deeper. The relationship between risk and return is a critical concept to grasp. It's like a seesaw. As the potential for higher returns increases, so does the risk. Why? Because investments that offer the chance for high returns typically involve a higher level of uncertainty or volatility. That's the risk you take. On the other hand, investments that are considered lower risk, like government bonds, typically offer lower returns. But don't let the word risk deter you. It's not about avoiding risk altogether, but rather about understanding and managing it. This involves assessing your risk tolerance, essentially how much risk you're willing and able to take on. For instance, if you're a daredevil, you might be more inclined to riskier investments with potentially higher returns. But if you're more cautious, you might prefer safer, more stable investments, even if they offer lower returns. Risk management also involves diversification, which we'll delve into in the next scene. But in a nutshell, it's about spreading your investments across different types of assets to reduce risk. Think of it as not putting all your eggs in one basket. Lastly, it's crucial to stay informed and keep a close eye on your investments. Markets can be unpredictable, and economic factors can have a significant impact on risk and return. By staying abreast of market trends and economic news, you can make timely adjustments to your investment strategy. Remember, investing isn't a gamble, it's a strategic game. And while high risk can lead to high returns, it's all about striking a balance that aligns with your financial goals and risk tolerance. By understanding and managing investment risks, you can make informed decisions and maximize your returns. Because in the end, the goal is not just to make money, but to grow it wisely and sustainably. You've probably heard the saying, "Don't put all your eggs in one basket." This is especially true when it comes to investing. Let's break it down. Diversification in the context of investing is the strategy of spreading your investments across various assets to reduce risk. It's akin to a balanced diet. Just as you wouldn't want to consume only one type of food, you wouldn't want to invest all your capital in one asset. Imagine having your entire investment in one company's stock. If that company tanks, so does your investment. But if you spread your investment across different stocks, sectors, or even countries, the downfall of one company or sector is less likely to wipe out your entire portfolio. Diversification is your safety net, your buffer against the unpredictable nature of the market. Remember, diversification doesn't guarantee profits or protect against all losses, but it's a proven strategy to manage your investment risks. Diversification is a key strategy to manage your investment risks and increase your chances of achieving your financial goals. Investing may seem daunting, but with the right knowledge and strategies, it can be a powerful tool for wealth creation. As we wrap up our discussion, let's take a moment to revisit the key points we've covered. We started by introducing you to the world of investments, shedding light on the various types you can consider. We then moved on to explore the magic of compound interest, a vital component for growing your wealth. We also discussed the relationship between risk and return, highlighting the importance of balancing these two aspects. And finally, we delved into the crucial principle of diversification, a strategy designed to spread risk and maximize potential returns. Investing doesn't have to be a daunting task. With the right tools, knowledge, and a dash of courage, it can be an exciting journey towards financial freedom. Remember, the journey of 1,000 miles begins with a single step. Start your investment journey today and watch your wealth grow over time.